The queue moves forward. No one at the window asks why the line keeps growing. Loan volumes climb. The approval rate does not change. No one adjusts the threshold. Risk assessment offices exist. They operate. Their conclusions do not travel far. Capital moves between institutions. Each transfer looks identical to the one before it. A mortgage is packaged with others. The package becomes a unit. The unit is sold. Housing construction accelerates in regions where demand is already saturated. No signal reverses the order. Internal risk thresholds exist on institutional record. They are not revised. They are not enforced. The securitization pipeline does not pause. It expands. The expansion is structural, not incidental. Borrowers sign. The institution records. The record moves to another institution. Leverage ratios expand across the sector. Each institution watches the others. None withdraws first. Credit rating processes run on schedule. The schedule does not account for what has changed. Warnings circulate within the institution. They do not reach the floor where decisions are made. Subprime origination volumes increase each quarter. The increase is logged. It is not questioned. The borrower does not know the loan has already been sold. The new holder does not know the borrower. The secondary market absorbs each new issuance. Appetite does not diminish. Scrutiny does not increase. Foreclosure rates in early indicator regions begin to rise. The data is available. It is not redistributed. Senior leadership receives performance metrics. The metrics confirm growth. The growth is the problem. Capital flows toward yield. The yield is real. The collateral behind it is not examined at the same rate. Regulatory examination cycles continue on their standard timetable. The timetable was set in a different decade. The asset becomes a liability the moment the borrower stops paying. That moment is approaching at scale. Interbank exposure accumulates through instruments whose full extent is held by no single institution. Appraisal values are set to support the transaction, not to reflect the asset. The distinction is not noted. What is being observed here has been observed before. Patterns repeat because no mechanism compels change. Household debt levels reach historic concentrations. Consumption continues. The two facts are not connected in policy. The loan officer does not ask what happens if the rate adjusts. The borrower does not know to ask. The bond market prices risk as low. Low pricing confirms low risk. The confirmation is self-referential. Pension funds purchase the highest-rated tranches. The rating reflects a model. The model does not reflect the asset. The first default cluster registers across servicer systems simultaneously. The cluster is not isolated. It is a pattern. Institutions with the largest exposure issue no public statement. The absence of statement is itself a position. Mortgage delinquency spreads from the periphery inward. Each new region confirms the one before it. Internal communications from this period show awareness. Awareness without institutional authority does not constitute action. The Federal Reserve holds rates at levels calibrated for an economy that no longer exists in that form. Bear Stearns hedge funds suspend redemptions in June 2007. The suspension is treated as contained. Lending continues through summer 2007. The pipeline does not recognize what the balance sheet already holds. By late 2007, write-down announcements begin. Each institution frames its exposure as exceptional. None is. Lehman Brothers files for Chapter 11. On September 15, 2008, the filing takes 4 minutes to process. The consequence does not. Interbank lending freezes within 48 hours. Institutions that lent to each other the day before now hold their reserves. Treasury and Federal Reserve intervention begins. The scale of what is being stabilized becomes visible only now. Millions of homeowners enter foreclosure. For most, the process arrives without warning. The system had its own warning years earlier. Congressional testimony begins in October 2008. The institutions present do not describe what their own records show. TARP allocates $700 billion to stabilize the banking sector. The figure is not challenged at the scale it implies. Unemployment reaches 10% by October 2009. The rate represents people. The people were not in the model. No senior banking executive is criminally charged for conduct during this period. The legal threshold is not met. It is not adjusted. The Dodd-Frank Act passes in July 2010. It is the longest financial regulation in American history. Its provisions begin years later. By 2012, major banks return to profitability. The structure that produced the failure is not materially altered. Settlements are reached with major institutions. The settlements do not require admission of wrongdoing. The practice continues under new names. The households that lost equity in this period do not recover it within the decade. The institutions that created the conditions do. Academic literature on this period now exceeds 10,000 published works. The mechanism it describes was visible before it completed. The question that remains is not whether the signals existed. They did. The question is, what made them insufficient to stop anything? The system did not fail because no one saw it. It continued because seeing it created no obligation to stop.